Hello, and welcome to the property market update for 2026 for New South Wales and the ACT. I'm Angus Moore. I'm the Executive Manager for Economics at REA Group, and I'm going to be taking you through a bit of an overview of where housing markets are at and where the economy is at today. To that end, I'm going to be starting with a bit of a backdrop in terms of where economic conditions are at, what's kind of sitting fundamentally underneath housing markets, and how we might expect that to evolve. I'll then move on to talking about what we're seeing in established housing markets, focusing on what we're seeing in home prices, but also a little bit on what we're seeing in terms of activity. Then going to take a little bit of a detour, talk about rental markets for a bit, both because rental markets are quite interesting at the moment in their own right, but also because of what they're meaning for investor activity, because investors have been one of the really critical stories in housing markets over the past couple of years. And I'll then finish with a little bit of an outlook, some themes that I think are going to matter for 2026 and beyond. So let's start with that economic backdrop. And really, there's kind of no better place to start an economic backdrop than with inflation. This chart here is showing what we call underlying inflation. This is the measure of inflation that the RBA prefers to look at. And the reason for that is it strips out things like fuel prices or temporary electricity subsidies, things that push inflation around but don't really matter for thinking about where inflation is and where it's headed. Couple things that you'll note from this chart. First, inflation absolutely surged coming out of the pandemic. You can see the RBA's 2 to 3% target band there. We were way above that. And that's why we saw those really rapid successive interest rate increases from the RBA through 2022 and into 2023. But the second thing you'll note there is if we fast forward to 2025, you can see inflation actually did come back down inside the RBA's target band, but has then come back out above the target band again. And in the red there, the RBA forecast, the RBA is expecting that that's going to continue. They're expecting inflation is going to move a little bit higher from here and that it will stay outside the target band for 18 months or so. That's obviously not what they want. They want inflation in the target band. It was a little bit of a surprise at the end of last year. September quarter data and then December quarter data that we got in January really showed that inflation turned out to be a bit more persistent and a bit higher than we had been thinking. And what that's meant, as you'll all be aware, is that we've already seen a rate hike in 2026. This chart here is showing average new mortgage rates. So, if you're a new borrower today and you went to a bank, on average, what rate would you expect to get? You can see it came down from the peaks that we were seeing in 2024 and early 2025 on the back of those rate cuts that we saw last year. But it has already started to move back up, with the rate hike that we've seen. And markets are expecting it's going to continue to move a bit higher. On current market pricing, one more hike is priced in, and there's about a 40 to 50% chance of a second rate hike by the end of the year. That leaves rates a little bit lower here than where they were last year by the end of this year because that second rate hike is not a guaranteed, but we're certainly going to get back towards, on these expectations anyway, back towards the sort of levels we were seeing. Now, inflation's a really big part of that story. As we talked about, inflation did come in a lot stronger than the RBA had been forecasting, has come back outside their target band. But it's not the only thing that's been driving rate hikes. Unemployment's also been a part of the story, which is what I'm showing on this chart here. So the purple here is showing the actual unemployment rate over the last 5 decades or so. And where we sit today at sort of low fours is very low by historical standards. It's not the lowest we've ever seen. You can see, unemployment was even lower coming out of the pandemic. We have drifted up a bit since then, but unemployment is very low today. And broadly speaking, the RBA is largely expecting that to continue. They are forecasting that unemployment will continue drifting up as it kind of has been for the past few years. But, even over the next 2 years, we'll still be below sort of, 4.5% for most of that time. What that means is, unemployment certainly today and probably even towards the end of the RBA's forecast horizon here, it's probably still below what the RBA would consider what they call neutral. It's a bit of a slippery concept and, there's no exact number for that, but it's loosely speaking, that the level of unemployment that the RBA thinks the economy is relatively well balanced. And so inflation's not picking up. The fact that we are seeing inflation pick up and unemployment quite low suggests that unemployment rate is below that neutral at the moment. So why? Why are we seeing relatively low unemployment? And, if you squint and you're wearing your glasses, you can see unemployment actually came down a little bit towards the end of 2025. part of the story is consumer spending looks like it's starting to pick up and strengthen. So this chart here is showing the change in consumer spending over the last sort of 6 or so years. You can see, that big drop that we had during the pandemic, hardly surprising, everything was shut, people couldn't spend money. That then comes back after borders reopen and, the economy reopens, people start spending money again. We see that big recovery. But then if we fast forward through to sort of late 2023 through 2024, you can see that line's more or less tracking sideways. And that's particularly notable because this is a period in which we're seeing pretty strong population growth. And so for total consumer spending to be tracking sideways means spending per person, per capita, was actually pretty soft through this period. But if we move forward to 2025 and, particularly towards the end of 2025, that line is starting to move up again, maybe not as rapid as at some points, but, it is still firming up there. And that's despite the fact that population growth has actually slowed down compared to what we were seeing a couple of years ago. So this looks like an environment in which we're starting to see a bit of a firmer kind of demand from consumers. Another perhaps more complicated way to see that is this chart here, which is showing how different types of spending in the economy are contributing to overall economic growth. So the things to focus on here are red, private sector spending, so that's businesses and households, and blue, public sector, the government. And the way to read this chart is the bigger the bar, the more that type of spending is contributing to economic growth. And so if we zoom in on 2024, 2025, you can see that through 2024, public sector government spending was contributing a lot to economic growth, and private sector was, almost negligible there. The red bars are really quite small, meaning that the private sector spending really wasn't growing very much and really wasn't contributing a lot to economic growth. But if we move forward into 2025, and particularly towards the end of 2025, that story flips. Government spending is starting to slow down. That's partly, state government infrastructure projects starting to wind up. And at the same time, that red bar, that private sector spending, is increasing. That's partly as we're talking about consumer spending firming up, but it's also business investment firming up. In the RBA's assessment, in the commentary that accompanied the rate hike, they spoke about how that firming up in private demand looks like it's probably supporting inflation. And so that was another reason why we saw that hike. I'm going to move away from the economy and talk a little bit more directly related to housing with population growth now. So starting with the chart on the left, I'm showing annual population growth for the country as a whole in purple and for New South Wales in orange. A couple of things will stand out from this chart. First, we've been through a period of really very strong population growth in recent years. That was mostly due to net overseas migration, and we'll talk about that in a moment. That's largely worked its way through though, and you can see that population growth has come back down to a sort of more typical pace compared to what's been true over the past few decades. But the other feature that'll stand out is that New South Wales is a typically slower growing state than the country overall. And I think that's a good segue into the chart on the right, which breaks apart population growth into the different parts of population that drive population growth here in New South Wales. So in blue is net overseas migration. That is people coming into New South Wales from overseas, less people leaving New South Wales to go back overseas. You can see that big surge that we saw post borders reopening. That was in part a function of the fact that very few people were leaving New South Wales for overseas during that period. And so the net, people coming in, less people leaving, was very, very strong. But here in 2026, 4 years post borders reopening, we're kind of through that adjustment period, and net overseas migrations returned back down to a more typical, more normal pace. But the reason that New South Wales grows more slowly than other states or than the country as a whole is the red bars, which is net interstate migration. That is, how many people are on net moving into New South Wales, less people leaving New South Wales for other states. And consistently across New South Wales, last few decades, those bars are below zero, meaning that more people leave New South Wales than come into it. That was particularly strong through the pandemic and into 2023, but is starting to abate a little bit today. It's still relatively strong, particularly compared to the 2010s when New South Wales was growing a bit more strongly. But we are, starting to see some of that COVID era, flight to other states starting to abate. Just to drill into Sydney a little bit more, in terms of where people within Sydney are moving to, elsewhere in Sydney or to other parts of the country, the purple here shows people on net leaving that area, and the red shows people on net moving to that area. Most of Sydney on net sees people moving elsewhere. That's particularly true in the inner city for reasons we'll talk about in a moment, but most of the city sees this. The only real exceptions are, some of those high development areas in the southwest and northwest, where on net more people from Sydney are moving to them than are moving from those areas to other parts of Sydney or the country. But that's not to say that the inner city in Sydney is losing population overall. And the inner city is a really good example here. Chart on the right is showing total population growth. So that is that internal migration on the left plus overseas. And here you can see that actually the inner city is growing quite strongly. And the reason for that is it sees a lot of people moving in from overseas, and then those people move elsewhere in the country. Now, that obviously matters for thinking about housing demand. Total population clearly matters for housing demand. But internal migration is also important, particularly in the established market, because people moving within cities is often going to be an important part of people, looking to up or downgrade or, move in search of buying a home as opposed to necessarily renting. Just to talk about the ACT a little bit before we move on to established housing markets, same two charts that we were talking about for New South Wales, but for the ACT. Focusing on the right, you can see, again, that surge in overseas migration. The overseas migration remains relatively firm in the ACT, though of course it is a smaller territory than, say, New South Wales. But you can see, interestingly, the ACT is still losing people and fairly consistently over the past couple of years to other parts of Australia, which is relatively unusual for the ACT. The ACT is obviously a little bit more volatile than New South Wales, both because it's, a smaller market than New South Wales as a whole, and also because it has more kind of idiosyncratic economic conditions, given the concentration of employment there. But the fact that we've been seeing, net population outflows is fairly unusual for the ACT and has been contributing to, housing demand or, the softer conditions. So let's talk about that right now. Home prices in 2025 in Sydney and Canberra were actually relatively solid through much of the year, though things did start to slow down towards the end of the year. So the chart here is showing the change in home prices relative to the start of 2020. It's a nice period to kind of look at the sort of longer run trend in home prices. On the left, you can see Sydney, Canberra, regional New South Wales, and the national. And then on the right, I've got some other cities for a bit of contrast. Sydney, has seen prices up over the past 12 months, about 5.5%, which is, a little bit slower than average, but still relatively firm, and certainly better than what we had been seeing through, say, 2024, or, certainly through, say, 2022 when prices were falling on the back of RBA increases in rates. But it's certainly not a rapid pace of growth. Canberra, similar story. Prices have been even a bit more sluggish than what we've seen in Sydney in recent years since the RBA started raising rates. In part, that's those net outflows that we were talking about, to other states on the slide before. But you can see that starting in 2025, prices did start to increase. And over the year, past 12 months or so, home prices are up about 4% across Canberra. You can see right as we get to the end of the year, that otherwise pretty solid, consistent growth that we saw through 2025 stalled out a bit. Both Sydney and Canberra saw price falls at the end of last year. They weren't very large. I wouldn't want to pull too much on them. I'd largely characterize this as tracking sideways. Home prices in both are still a little bit below their peak in November, but again, it is only a very little bit, so I wouldn't want to draw too much to it. But that is in contrast to what we've been seeing in Adelaide, Brisbane, Perth. And you can see Perth and Brisbane there on the right. Home prices have just continued apace in those cities. They've more than doubled since the start of the pandemic, which is a pretty remarkable pace of growth over such a short period of time. And growth last year was still quite firm in both cities, up double digits in both, and Adelaide as well. And kind of showing very little sign of slowing down. Part of the story there is that there has been relatively little stock on market and choice for buyers in those cities, whereas Sydney, Melbourne, to some extent Canberra, have been seeing relatively good choice, as we'll talk about in a moment, and that's probably put a little bit of downward pressure on prices, particularly towards the end of the year. Just drilling into Sydney a little bit more, the softness that we saw towards the end of last year really was concentrated among detached houses, which you can see here in the sort of red. Whereas higher density, so semi-detached and apartments in the yellow, it slowed down. The pace of growth that we saw towards the end of the year was not as good as we saw through the rest of 2025, but we didn't see the price falls that we did in detached. And that's consistent if we kind of split the market out by price segment. If you look at, where the price falls were concentrated, it was amongst those more expensive homes in the red here, whereas the sort of middle and lower end of the market in the purple and blue, again, they leveled off, but they were sort of relatively flat through the end of the year rather than actually seeing price falls. In terms of across the city, outer suburban areas have been outperforming over the past sort of 12 months or so. And really, that's probably not just true for the past 12 months, that's probably true over a longer period as well. You can see this chart here, just the redder an area, the faster the pace of growth that we've seen over the past 12 months. You can see, some of those southwest, northwest areas have seen stronger growth than, particularly the North Shore, inner east and south markets. Though I wouldn't want to put too fine a point on this. There's not a huge gap between the sort of best and worst performing areas here, and certainly not as large as perhaps we had been seeing during the pandemic when there were really big divergences between inner city and outer suburban markets. But there are some evidence, or is some evidence here that those affordability constraints, the fact that rates look like they're rising, may be weighing a bit more heavily on the more expensive end of the market, those more expensive inner city markets than on those more affordable outer suburban areas. Moving away from home prices now and talking a little bit about listings activity and market activity. Chart here shows the number of new listings by month. It's a fairly complicated chart, but we do it this way because, listings are very seasonal. Obviously very few people list at the end of the year. Spring is very busy. And so you want to be able to compare kind of month to month. And so the way to read this chart is to follow one of the lines. The colors each represent a calendar year, and then compare it to the other years at any given point. And so starting with Sydney on the left, you can see that 2025 was a fairly solid year, certainly above average over the sort of, preceding decade. That's that black line there. But it wasn't as strong as 2024 through most of the year. There was an exception in October and to some extent November where it was a little bit stronger than what we saw in 2024, but across the rest of the year and the year overall, not quite as busy a year as we saw in 2024. Nonetheless, still a better than average year, still a reasonable amount of stock on market, and that's, potentially, particularly as we came into the end of the year, part of what weighed on home prices. Pretty similar story in Canberra on the right there. Again, you can see that blue line for 2025, pretty consistently above average, but again, a bit more volatile than Sydney, given it is a smaller market, but again, mostly sitting below that red line for 2024. That wasn't entirely true across the city. We did see that some parts of the city were a little bit quieter than average. You can see, the sort of central coast there was a little bit below average in terms of listings activity. But most of the city saw a busier than typical period, and particularly down in the southwest was quite a lot busier than has been true over the past decade. In part, that's just because these are bigger markets. There are just more homes in those active development areas than there were 10 years ago, and so naturally over time, activity in those areas increases. But even in more established parts of the city, around the sort of inner west, inner south, even to some extent the lower North Shore and North Shore, things were still a bit above what would be typical for Sydney. All right, I'm going to take a bit of a detour now and start talking about rental markets. And I'll start where I always like to start with rental markets, which is rental vacancy rates. So rental vacancy rates measures the share of rent of all rentals that were available for someone to move into as at the end of the month at any given point in time. Obviously, a bit of a volatile measure. It obviously depends month to month. Lots more people, or lots of renters move in January, which makes, can make availability a bit higher then than, say during the middle of the year. And also it depends on, when in the month people move out as to whether that rental is available and vacant at the end of the month. So it can be a volatile measure from month to month. So we try and look through the sort of longer run trends here. And when we do that, the longer run trends are that availability remains pretty challenging. You can see availability rental vacancy rates in Sydney are sitting sort of around 1.5%, which is fairly low for Sydney. You can see pre-pandemic more like 2 to 2.5 was typical. In Canberra, a bit of a different rental market, obviously a lot smaller than Sydney. Rental vacancy rates, as you can see, historically have been a bit lower. They did drift up through sort of 22, 23, which was very different from what we saw in other parts of the country. But again, that availability has come down a bit over recent years. But kind of shifting attention back to Sydney and or even looking at capital cities as a whole on the right or regional areas as a whole on the right, the story has been broadly speaking over the last few years of very, very limited availability, but that things have improved a little bit from the sort of 2022, 2023, absolute trough peak of the rental crisis that we were seeing a few years ago. That's translating into rents. The fact that availability is still very, very tight means rents are still growing very quickly. You can see, on the left there for Sydney, houses in the pink, units in the purple. Rents are up, median advertised rents are still up about 4% in the past year, which is still pretty solid growth for Sydney. That is faster than what was typical through, kind of the 2010s. It's faster than what you might consider as a sort of, normal long run rate of sort of 2.5%, kind of consistent with the RBA's inflation target. So it is still a fairly brisk pace of growth, but it is nothing like the pace of growth we were seeing back in 2022 or 2023 when rents were growing at, double digit rates. So, again, that's consistent with that picture of conditions still being very tight, very competitive, but just not as tight and competitive as we perhaps had been seeing. Story is very similar in regional New South Wales. Canberra, on the other hand, a little bit different story as we were talking about. Availability had been a little bit better through sort of 22, 23, 24, maybe tightened up a little bit more recently. As a result, rents haven't been seeing the pace of growth that they had been seeing in other parts of the country over recent years. Canberra's rental market kind of has been following its own trajectory a little bit relative to what we've been seeing elsewhere. Interestingly, that shows up in investor activity as well. Investors have been a really important part of the story in housing markets over the last couple of years, really around most of the country. And we'll start with New South Wales on the left because it's illustrative of what we're seeing more or less around the country, but obviously also what we're seeing in New South Wales. We saw a lot of investor activity during the pandemic. That was not unique to investors. That was a very busy time for housing markets generally, and so we saw a lot of activity from everyone. But you can see that activity start to calm off as the RBA raises rates very rapidly. We see a big fall in activity. But then as rates stabilize in 2023, amid very tight rental market conditions and very fast growth in rents, we start to see investor activity ramping up. And that has continued apace through 2025. And actually, today we're seeing kind of record numbers of investors buying in New South Wales. That's not unique to New South Wales. If we look at Brisbane and Queensland, if we look at WA, if we look at SA, if we look at the Northern Territory, you see this pattern emerging as well. The ACT, to a lesser extent, investor activity, obviously much smaller market, much smaller numbers that we're talking about in terms of number of investors, but it has been running more or less sideways over the last few years. It was higher during the pandemic, again, consistent with that being a busy period, but just generally speaking, a bit quieter post that period and hasn't seen that same ramp. Again, consistent with the fact that rents just haven't grown as much. In terms of where we're seeing that investor activity, obviously we're seeing that in inner city areas. You can see, so the chart here is showing where investors are inquiring. Deeper red means investors are making up a higher share of inquiries in that area. Obviously, inner city areas are very popular with investors, as we'd expect them to be. The city ranks 8th here in terms of in investor inquiry. You'd expect that given that it's a large, liquid, deep rental market. But actually, if we look at where investors are overrepresented, it's actually some of the more affordable parts of Sydney, places like St Mary's, Fairfield, Mount Druitt, Blacktown, that are ranking up among the areas seeing the highest share of investor interest. Again, this is not a pattern that's unique to Sydney. We see this in a lot of the capital cities where some of the most popular areas for investors are those more affordable entry points. So not only are we seeing a lot of demand for not a lot of demand from investors, we're seeing a lot of demand for investors in those more affordable areas. And those more affordable areas have typically seen stronger growth in recent years. Just to wrap up on investors, I'm going to finish with this chart because I think it really underlines the point that I'm trying to make here quite nicely. This chart is showing the share of new housing lending that's going to investors. So you can think of it as, given the buyer pool, what share of that buyer pool are investors? It's not a perfect one-for-one match because not everyone buys with a home loan, but it's kind of the best proxy that we have. You can see New South Wales there on the left, it is at very, very high levels at the moment. Around 45% of new housing credit is going to investors in New South Wales. It's not a record. We have seen higher periods. You have to go back about a decade to find, when investors were such a high share of the buyer pool, but it is high relative to what's been true historically. Again, if we look at Queensland on the right, nearly a record. If we look at WA, same story. SA, same story, is a record or just shy of. Northern Territory is a record or just shy of. September were the records for South Australia and Northern Territory, and December only just behind them. So investors are making up a huge share of the buyer pool in many states. The ACT, as we talked about, that just hasn't been as much the case. We just haven't seen as much of a ramp in investor activity there, in part because we just haven't seen that growth in rents. Interestingly, Victoria hadn't for a long time. A few reasons for that, but we are actually starting to see a bit of a pickup in investor activity there. You can see the last 6 months of 2025 saw a fairly sharp tick up in the share of loans going to investors, even in Victoria. Right. I'm going to move on and wrap up with a few themes that I think are going to be important for 2026 and beyond. And the first one's maybe a bit of a down note to start on, but the new homes market remains fairly challenging. Residential construction remains fairly challenging, and we're just a long way behind the sort of pace of building that we would need in order to hit that National Cabinet target of 1.2 million homes over 5 years. So you can see here for national on the left and for New South Wales on the right, red for detached houses, blue for higher density. We are a long way behind that dash black line of what we would need to build to hit that target, particularly in New South Wales. It's not to say it's impossible. You can see if we go back a decade, we weren't actually very far behind the target. And of course, we're a smaller country 10 years ago. And the real difference is in higher density. We build about as much detached today as we have for decades nationally, but we used to build a lot more high density, and we're just not today. There are some signs that's starting to change. There is early indications in building approvals, for instance, which lead building completions by quite a bit. That higher density is improving, particularly in New South Wales, but remains to be seen if that translates. The fact that we haven't seen a pickup in detached, though, is a little bit interesting because we did see a surge in approvals and commencements, so people starting work during the pandemic on the back of home builder. That didn't really translate into actually built homes. And that reflects a lot of the headwinds that the residential construction sector has been facing. Costs were growing really quickly during the pandemic. It's been very hard to find labor, and it's taking longer to build homes than it used to. The good news, this has all been fairly negative, but the good news for the outlook for new homes is that those headwinds, while still there, are starting to abate. Costs are still higher. It just does cost more to build homes than it used to, but we're not seeing the pace of cost growth. And so we're not in that environment of uncertainty about costs that we were a few years ago, which makes it just that bit more predictable for builders. Similarly, it looks like labor constraints are maybe starting to ease a little bit. Residential construction employment has been increasing. And while it's still taking longer to build homes than it used to, that time has actually started coming down. So we're headed in the right direction there. Second theme that I think is going to be important through 2026 is first home buyers. And the reason for that is we saw some policy changes from the federal government towards the end of 2025 to support first home buyers. The two on the slide here are the Australian government 5% deposit scheme, which does what it says on the tin, allows any first home buyer to buy with a 5% deposit and not have to pay LMI. There's also the shared equity scheme that came into effect in December, though this is a more limited program. There are caps on the number of places, and unlike the 5% deposit scheme, you have to be under a certain income in order to be able to take advantage of that shared equity program. The 5% deposit scheme has actually been around for a while, but it did used to be capped. Those caps were removed on 1 October. So this will clearly pull forward some first home buyer demand. It's hard to know how much, but it does look like we're starting to see the impact of that already. So the chart here is just showing the number of first home buyers across New South Wales. And you can see the last 3 months of 2025 there, we did see a tick up. Now, obviously, the number of first home buyers can move around for a lot of reasons. We can't pin this exactly on the 5% deposit scheme. And This is only covering from October through December, so it is very early in the operation of the scheme, and pretty quick for someone to have got on the scheme and then bought and settled a home. But the fact that we've seen something does suggest there is some pull forward of first home buyer demand there. And so as we get more into 2026, as people have had more time to get onto the scheme and start finding homes, be interesting to watch to see if this pickup in first home buyers continues. If it does, that is going to obviously have more of an effect on those more affordable segments where first home buyers tend to focus. And just to round out, I started talking about inflation. I'm going to finish talking about inflation. And this chart here, I think, really underlines the point of how important inflation is at the moment. What it shows is in black, the actual RBA target cash rate, and then in the different colors, what markets were expecting it would do over the coming, 18 months to 2 years. And you can see in red, back in late October, not even that long ago, a few months ago, we were actually expecting two cuts. But then between the red and the blue line, we get the September quarter inflation data. And that shows that inflation was more entrenched and higher than we had thought. And so we go from expecting two cuts to expecting, one-ish hikes. And then between the blue and the purple today, we get the December quarter inflation data, which showed that, yep, no, inflation definitely is more persistent than we thought. And in fact, it's probably even higher than we thought it was. And so we go from in late October expecting a couple cuts to today expecting, well, having already had one hike and expecting at least one and maybe a second, sort of 40 to 50% chance of a second. So the point to make here is twofold. One, that's the outlook for rates, probably at least another hike, maybe two by the end of the year. But also it's inflation that is going to determine what happens with the cash rate from here. If inflation evolves as the RBA expects, we'll probably see that purple line. But if it comes in under expectations, if it turns out that these couple quarters were just a bit of a transitory blip, we may see inflation come back down, back inside the target band, and those hikes not need to eventuate. But it's really inflation that's going to determine that, and we'll just have to wait and see. With that, thank you very much for your time. I hope you found that helpful. Thank you.